What are the tax implications of selling the house during a divorce? Have you ever wondered what happens to the taxes when a couple sells their home during a divorce? It can be a bit tricky, but understanding the tax implications is essential. Let's break it down in simple terms. First, when a house is sold during or after a divorce, the Internal Revenue Service generally does not consider the transfer of property between spouses as a taxable event. This means if one spouse gets the house as part of the divorce settlement, there is no capital gains tax owed just because ownership changed hands. Now, when it comes to selling the house, there is a potential tax benefit if it was the primary residence. The Internal Revenue Service allows individuals to exclude up to $250,000 of capital gains from taxes. For couples filing jointly, this exclusion can go up to $500,000. To qualify for this exclusion, the seller must have owned the home for at least 2 years within the last 5 years and lived in it as their primary residence for at least 2 years as well. If the couple sells the house before the divorce is finalized, and they are still legally married for the entire tax year, they can claim the full $500,000 exclusion together. However, if the sale happens after the divorce, each spouse can only claim up to $250,000 individually, provided they meet the ownership and residency requirements. If one spouse does not meet the full 2-year residency requirement, there is still a chance for a reduced exclusion. For example, if a spouse lived in the home for just 1 year, they might be able to exclude a portion of the capital gains, like $125,000 instead of $250,000. In cases where the divorced couple still jointly owns the home after the divorce, both can claim their individual capital gains exclusion when the house is sold. This is based on their individual ownership and use of the property. If one spouse buys out the other's share of the home as part of the divorce settlement, this is treated as a marital property transfer. This means there is no capital gains tax at that moment. The spouse who buys out the other assumes full ownership and the related tax basis. It's also important to consider mortgage debt in these situations. While the focus is often on capital gains, how mortgage debt is divided can impact the timing and ability to sell the home. The spouse who keeps the house usually takes on the mortgage debt, which can affect the financial outcome of the sale. Selling a house during or after a divorce involves careful attention to tax rules regarding property transfers and capital gains exclusions. Timing the sale relative to the divorce finalization and meeting ownership and residency requirements are key factors that can help reduce or eliminate capital gains taxes. Understanding these elements can make a big difference in the financial outcome for both parties.